Welcome back. Now, the country's first dedicated debt trading platform launched by the NSE this month hasn't been able to create much of a buzz, while other exchanges like BSE and MCXSX are also now in the process of launching similar platforms, having just got the nod. Low volumes and lack of regulatory nods mean the segment has yet to overcome a few hurdles before it truly takes off in India. Sajit Mangat and Sunanda Jayasilan analyze.
A weakness in our financial system relates to the market for corporate debt. While the market for government debt is very large, the market for corporate debt has yet to develop as it should.
And the PM is not alone. Most veterans at North Block acknowledge the need for a vibrant debt market. Yet, there seems to be no movement to make the segment investor-friendly. Early this month, the NSE launched its debt market segment, and even though these are early days, the initial response has been muted. Exchanges and market participants attribute the low trading volumes to a number of reasons. To begin with, lack of institutional investor participation. At present, settlement guarantee is provided only to the retail segment and not to institutional investors who argue they have no cushion in case of the other side defaulting in settling payments.
Settlement guarantee will provide anonymous market. Otherwise, you end up doing basically one-on-one OTC kind of situation where you a priori would like to know who you want to deal with, because you don't know. If you do it on an anonymous basis and if there is no settlement guarantee, then there is a settlement risk.
But even as SEBI mulls over whether settlement guarantees should be provided to institutional investors as well, it is faced with another issue: the margin requirement that goes along with settlement guarantees. While SEBI has asked for 10% margins in case of securities with a rating of AA or above and 25% for all other securities, it is finding it difficult to impose this on institutions, considering institutions in India work on thin margins.
The margins has to be such that it takes care of the risk, and it's not so much that it sort of prohibits efficient activities.
Last but not least, the current framework only allows banks to come on the platform, while primary dealers, mutual funds and insurance companies cannot participate directly in the debt segment. With regulatory nods needed for that to become a reality, exchanges are hoping SEBI and the Finance Ministry will work quickly towards a more enabling framework to perk up a tepid debt market platform. In Mumbai, with Sajit Mangat, Sunanda Jayasilan.
But of course, some forward movement